Hi and welcome to Penser Bank. My name is Markus Almerud and I'm an analyst here at the bank. Today we're going to talk about Lagercrantz. Lagercrantz is an acquisition-driven technology company with about 70 decentralized subsidiaries. Each subsidiary targets to be a leader in its specific niche, with a fair value range of 133 to 135 and the share is just above 100. The investment case in short is that we believe that the strong track record of growing earnings through a combination of growing top line and expanding the margin will continue. The strong balance sheet in combination with a good acquisition pipeline will continue, and the company targets to double profits over the next 5 years despite just having doubled. Also, notice in the picture that the earnings trend is very stable, and we'll get back to this. Today we're going to talk about top line growth, organic growth in M&A, we're going to talk about the margin expansion, and we're going to talk about valuation. So starting with top line growth, organic growth is normalizing, but this is perfectly natural. In the last quarter we saw negative organic growth, but it's important to point out that it was unchanged sequentially, and we did see an uptick in order intake towards the end of the quarter. But most importantly, and we keep coming back to this, M&A is the most important driver, accounting for some 2/3 of earnings growth over the past decade. Looking at M&A specifically, we hear that the M&A market has normalized. It's easier to find good targets at okay prices. Looking at the balance sheet, it has the strongest balance sheet among peers. Continuing with the margin expansion, Lagercrantz has expanded the margin in a very impressive way over the past decade. There are a number of reasons for this. They have increased the share of proprietary products. We've seen a general improvement of subsidiaries' results. They have made margin accretive acquisitions, and they have managed to raise margins in the acquired units. Looking at the gross margin, we've seen a continuous uptick, but it's also accelerated in the recent past. So this trend continues. We do think that there is more to go for. Digging down into the specific units, we do see a number of units with single-digit margins, so there is more to go for. Finally, looking at valuation, we have seen a very interesting trend emerging. There is a divergence between the share price and the EPS, and most recently, that is after the Q2, we have seen this trend accelerate, and this creates a very interesting situation. We do see a value of over 130 Swedish krona, but we do see a value of almost 175 in 5 years. The reason why we think it's fair in this particular case not to discount is the stable earnings trend that you saw earlier in the presentation. So in summary, we do have a company which is mainly driven by M&A, who do have a very strong balance sheet, who's a very good pipeline to make acquisitions, and hence we should see earnings accelerate, who just set new targets to grow earnings from 1 to 2 billion Swedish krona after just having doubled earnings over the past couple of years. On top of that, the earnings trend and the share price has diverged, and this creates a very interesting situation. Thank you.